If you are a senior, an immigrant, a green card holder, or someone who simply files taxes in the United States, a brand new IRS rule is coming in 2026 that could change the way you file forever. And this is not a small update. This rule could affect your tax return, your savings, and even your immigration status if you are not careful. Imagine filing your taxes the way you always have, just like you've done for years, and then suddenly receiving a notice from the IRS saying you failed to report something you didn't even know you were supposed to report. Now imagine that mistake triggering penalties, an audit, or delays in a citizenship application. That is exactly why this new rule matters so much. Starting in 2026, the IRS is rolling out new mandatory reporting requirements that specifically impact seniors over 60 and anyone who was not born a U.S. citizen. Many people have no idea this change is happening, and that is dangerous. But here is the good news. Nothing in this video is meant to scare you. The purpose is to prepare you. If you understand what is changing and you follow a few simple steps, you can avoid problems completely. Over the next few minutes, I am going to break this down in clear, simple language so you know exactly what the new rule is, who it affects, and what you should do right now to stay protected. By the end of this video, you will know whether this applies to you and how to handle it with confidence. But when the government changes something important, it can feel confusing and even a little frightening. That is why I'm here. My goal is to walk you through this step by step in plain, simple language without legal jargon and without unnecessary panic. So, take a deep breath, relax, and let's go through exactly what the IRS is changing and why it matters to you. Let's begin with the most important question. What exactly is this new IRS rule? Starting with the 2026 tax year, which means the returns you will file in early 2027, the IRS is introducing expanded mandatory reporting requirements on the standard tax return form 1040. This change is part of a larger effort by the IRS to improve financial transparency and increase compliance with foreign account reporting laws. In simple terms, the government wants more detailed information from certain taxpayers about money, assets, and income that exist outside the United States. Under the new rule, anyone who is 60 years of age or older and anyone who was not born a U.S. citizen will now be required to answer additional questions directly on their regular tax return about foreign bank accounts, foreign pensions, foreign Social Security benefits, and international money transfers. These are questions that used to appear only on specialized forms or were sometimes optional depending on your situation. But beginning in 2026, they will become mandatory for millions of taxpayers. This means that seniors, green card holders, naturalized citizens, and many visa holders will no longer be able to skip over these sections or assume they do not apply. The IRS is also strengthening data sharing between agencies like USCIS and the Social Security Administration, which means the information you report on your taxes will be more closely compared with immigration and financial records than ever before. The goal, according to the IRS, is to reduce what they call unintentional noncompliance, meaning situations where people break tax rules simply because they did not understand them. But regardless of the reason, once this rule is in place, the responsibility will be on you to answer these new questions correctly and completely. Even if you have filed taxes the same way for decades, the 2026 return will look different, and ignoring these changes could create serious problems. That is why understanding this update now, before it takes effect, is so important. One of the biggest parts of this new rule involves changes to the reporting thresholds for foreign financial assets. In the past, many people did not have to worry about filing additional forms because the limits were relatively high. Under the old system, you only had to file Form 8938, which reports specified foreign financial assets, if the total value of those assets was more than $50,000 at the end of the year, or more than $75,000 at any point during the year for single filers living in the United States. But the new 2026 rule dramatically lowers those limits for seniors and immigrants. Now, if you are over 60 years old, or if you are an immigrant filer of any age, the threshold drops to just $25,000 at the end of the year, or $40,000 at any time during the year. That is a huge change. It means that many people who never had to report foreign accounts before will suddenly be required to do so. And when we say foreign assets, we are not only talking about large investment portfolios. This can include simple things like a bank account in your home country, a small retirement account from years ago, a life insurance policy with cash value, or even partial ownership of family property overseas. In addition to Form 8938, there is also the FBAR, which is the Foreign Bank Account Report. The FBR rules themselves are not changing. You still must file an FBR if the total value of all your foreign accounts combined exceeds $10,000 at any point in the year. However, what is changing is the way the IRS will cross-check this information. Under the new system, your answers on Form 1040, your Form 8938 if you file one, and any FBAR records will be automatically compared. If you answer yes to having foreign accounts on your tax return, but fail to file the required forms, or if the numbers do not match, the system can generate automatic notices and potentially trigger an audit. In other words, there will be much less room for mistakes, misunderstandings, or forgetting to report something small. This is why even people with modest savings outside the United States need to pay very close attention to these new requirements. At this point, you might be wondering something very reasonable. Why are seniors and immigrants being singled out by this new rule? The IRS has given a clear explanation for this. According to their own studies, these two groups represent the largest source of unintentional mistakes when it comes to foreign account reporting. Many seniors have lived long, complicated financial lives. Some retired abroad and later returned to the United States. Others receive small pensions or government benefits from countries where they worked decades ago. A lot of them simply do not realize that the United States requires worldwide income reporting, even if that income is small or already taxed in another country. The same is true for immigrants. Millions of people who move to America keep bank accounts, property, or investments in their country of origin. They may use those accounts to support family members, save for emergencies, or handle financial matters back home. From their perspective, those accounts have nothing to do with the United States, but under U.S. tax law, they do. The IRS believes that many people in these groups are not intentionally hiding anything. They just do not understand the complicated reporting rules. The problem is that from the government's point of view, whether a mistake is intentional or not, it is still considered non-compliance. So instead of relying on people to discover obscure forms on their own, the IRS has decided to force the issue by making these questions impossible to miss. By placing them directly on the main tax return and lowering the reporting thresholds, the government is essentially saying that no senior or immigrant can claim they did not know anymore. Even a small inactive bank account that you forgot about could now require formal disclosure. That is why this change is such a big deal, and why so many people will be affected starting in 2026. Before we go any further, let me pause for just a moment. If what you are hearing right now is helping you understand something you did not know before, take a second to like this video so more seniors and immigrants can find this information. These rule changes are confusing, and the more people who see this, the fewer people will end up with unnecessary problems later. Now let's talk about how this new rule affects different groups of people, because the impact is not exactly the same for everyone. If you are a senior who is already a U.S. citizen by birth, You might be thinking this does not really concern you, but that is not necessarily true. Under the new requirements, any senior over the age of 60 who has financial connections outside the United States will have to answer the expanded questions on their tax return. If you receive a pension from another country, if you have a small savings account overseas, or if you still own property or investments abroad, you will now be required to disclose that information more clearly than ever before. Even accounts that are rarely used or that you only keep open for convenience when visiting family will count. The IRS is no longer treating foreign assets as something only wealthy people need to worry about. For seniors, the assumption will now be that if any foreign accounts exist, they must be reported properly and in detail. For green card holders, the situation is even more sensitive. As a lawful permanent resident, you are already required to follow the same tax rules as U.S. citizens, including reporting worldwide income. But what makes this new rule especially important is the connection between taxes and immigration. When you apply for U.S. citizenship, USCIS reviews your tax history as part of the good moral character requirement. Under the updated system, USCIS will have greater access to IRS data and will be able to see whether you answered the foreign account questions correctly, whether you filed required forms like the FBR or Form 8938, and whether there are inconsistencies in your records. This does not mean that a simple mistake will automatically ruin your immigration case, but it does mean that any mismatch or missing information can trigger delays, extra questioning, and additional scrutiny during a naturalization interview. In some situations, serious tax noncompliance could even lead to denial of an application. That is why green card holders in particular need to be extremely careful and organized once this rule takes effect. If you are a naturalized citizen, you might assume that because you are now fully American, these rules no longer apply to you in any special way. But the IRS has specifically included naturalized citizens in the expanded reporting group. The reasoning is simple. People who were not born in the United States are statistically more likely to still have financial ties to other countries, even many years after becoming citizens. So, even though you are treated the same as any other American for tax purposes, you will still be required to answer the new questions in more detail. And for those who are in the United States on work visas or other temporary statuses, the rule can matter as well. If you meet the residency requirements for U.S. tax purposes and file tax returns here, you will also be subject to these expanded reporting obligations. For visa holders who hope to apply for a green card in the future, tax compliance is extremely important. Problems with IRS reporting can complicate visa renewals, adjustment of status applications, and other immigration benefits. In short, this new rule reaches far beyond just retirees. It touches almost anyone who has lived, worked, or built a life across more than one country. So, the big question now is very simple. What should you actually do to protect yourself? Instead of worrying, the smartest approach is to take a few practical steps right away. The first and most important step is to gather complete information about any financial connections you have outside the United States. This means making a clear list of every foreign bank account, pension, investment account, insurance policy with cash value, property interest, or business ownership you might have. Even if an account has very little money in it, even if it has been inactive for years, and even if it is only used occasionally when you travel, it still counts. Write down the name of each institution, the country where it is located, the account number if you have it, and the highest balance or value during the year. Many people get into trouble simply because they never took the time to organize this information. Doing this one step early can save you enormous stress later when the new rule takes effect. The second step is to review your current FBR filing situation. Remember, the FBR requirement already exists today and is not waiting until 2026. If the total combined value of all your foreign accounts ever went above $10,000 at any point in the year, you are required to file an FBAR electronically with the Financial Crimes Enforcement Network. This applies even if each individual account is small. Many seniors and immigrants are surprised to learn that this rule has been around for years. If you realize that you were supposed to file FBA bars in the past but never did, do not panic. The IRS offers programs known as streamlined filing procedures that allow people to come into compliance with reduced penalties if their failure to file was not intentional. The worst thing you can do is ignore the issue and hope it goes away. Taking action now before the new 2026 system increases enforcement is one of the smartest decisions you can make. The third step is to prepare for the new Form 8938 requirements. Because the reporting thresholds are being lowered, many people who never had to file this form before will suddenly need to start filing it. If you believe your foreign assets might be above the new limits of $25,000 at the end of the year or $40,000 at any point during the year, begin collecting statements and records now. Form 8938 requires detailed information about each asset, including values in US dollars. Waiting until the last minute during tax season can make this process very difficult, especially if you need to contact foreign banks or institutions to get old records. Being proactive will make the transition to the new rules much smoother. The fourth step is to make sure you are correctly reporting any foreign income you receive. This is especially important for seniors who get pensions or Social Security type payments from another country. Many people assume that because this money is already taxed overseas, it does not need to be reported in the United States. But in most cases, U.S. tax law requires you to report worldwide income, including foreign pensions, annuities, rental income, or interest earned abroad. Some countries have tax treaties with the United States that may reduce or eliminate double taxation, but those rules can be complicated and vary from country to country. The new IRS questions on Form 1040 will specifically ask about these types of payments, so ignoring them will no longer be an option. If you are unsure how to handle foreign income, speaking with a qualified tax professional who understands international tax issues can make a huge difference. The fifth step, which is particularly important for green card holders and anyone planning to apply for citizenship, is to keep organized records of everything related to your taxes. This means saving copies of your tax returns, FBR filings, Form 8938 if you file it, and any documents that show the value of your foreign accounts. When you go through the naturalization process, USCIS may ask to see proof that you have properly complied with tax laws. Having clear, well-organized paperwork can turn what might feel like a stressful interrogation into a simple and straightforward conversation. Many immigration delays happen not because a person did something wrong, but because they cannot easily prove that they did things right. Good record keeping is one of the easiest ways to protect yourself. To help you understand why all of this matters in the real world, let me share an example that illustrates how easily problems can happen. Imagine a senior immigrant who has lived in the United States for decades and has always filed taxes honestly. She keeps a small bank account in her home country with about $15,000 in it, money she uses when visiting family. Because the amount is not very large, and she never thought of it as connected to her American taxes. She never filed an FBAR and never mentioned it on her tax return. Years later, when she applies for U.S. citizenship, the immigration officer asks about foreign accounts. Suddenly, this small innocent account becomes a major issue. Her application gets delayed while she works with a tax professional to correct past filings and prove that the mistake was unintentional. The entire process becomes stressful, expensive, and frightening. Under the new 2026 rule, situations like this are far less likely to be overlooked. The mandatory questions on the tax return would force her to think about that account from the beginning. In many ways, the new system is stricter, but it is also clearer. It removes confusion and makes it much harder for honest people to accidentally make costly mistakes. There are also a few common questions that many seniors and immigrants are already asking about this new rule. So, let me address them directly. One of the biggest concerns is whether this change affects regular U.S. Social Security benefits. The answer is no. Nothing in the 2026 IRS rule changes the way normal U.S. Social Security payments are taxed. Those rules remain exactly the same as they are today. What the new rule does focus on is foreign Social Security or pension-type payments that come from another country. If you receive retirement benefits from a government outside the United States, those payments are generally considered taxable income here, unless a tax treaty specifically says otherwise. The expanded questions on Form 1040 will now ask more clearly about these foreign payments, which means you will need to report them accurately instead of assuming they do not matter. Another question people ask is whether tax treaties still apply. The answer is yes. Treaties between the United States and other countries can still reduce or eliminate double taxation, but you must properly report the income first in order to claim those benefits. The new rule does not cancel treaties, but it does make it harder to ignore foreign income altogether. Another very important topic to understand is the potential penalties for non-compliance. The IRS takes foreign account reporting extremely seriously, and the consequences for mistakes can be significant. If you fail to file an FBR when required, the penalty for a non-willful violation can be up to $10,000 per account for each year you did not file. If the IRS believes the failure was willful, the penalties can be far higher, sometimes reaching 50% of the account balance. For Form 8938, the penalty for not filing when required starts at $10,000 and can increase to as much as $50,000 if the problem continues after the IRS notifies you. Beyond the financial penalties, there are also practical consequences. Failing to report foreign assets can extend the amount of time the IRS is allowed to audit your tax returns. And for immigrants, it can create serious complications with visa renewals, green card applications, or citizenship cases. The important thing to remember is that most people who get into trouble did not intend to break any rules. They simply did not know what was required. The new 2026 system is designed to remove that excuse by making the requirements impossible to overlook. Before we move toward the conclusion, let me pause for just a moment with a quick reminder. If this information has been helpful to you, consider sharing this video with any senior parent, grandparent, or immigrant friend who might be affected by these changes. A simple share could save someone you care about from a lot of confusion and stress in the future. As we get closer to 2026, it is important to keep the bigger picture in mind. The purpose of this new IRS rule is not to punish honest people. The goal is to create a tax system where information is clearer, reporting is more consistent, and everyone is following the same set of rules. For many years, foreign account reporting has been confusing and easy to misunderstand. Millions of seniors and immigrants have made small, unintentional mistakes simply because the requirements were buried in complicated forms that most people never saw. The new system brings those questions directly onto the main tax return so that people cannot miss them anymore, in a way that actually provides more protection for ordinary taxpayers. If you answer the questions honestly and keep proper records, you should have nothing to fear. And if you realize that you may have made mistakes in the past, there are still options available to correct them before the new enforcement system becomes even stricter. Acting early, getting organized, and seeking professional advice when needed are the best ways to stay safe. The most important message I want you to take away from this video is that knowledge is your greatest protection. This rule change may sound intimidating at first, but once you understand it, the steps to comply are very manageable. Gather your information, understand your filing obligations, keep good records, and do not ignore foreign accounts simply because they seem small or unimportant. Small details are exactly what the IRS will be paying more attention to in the future. If you prepare now, instead of waiting until the last minute in 2027, you can avoid nearly all of the potential problems that this new rule could create. Let's take a moment to quickly recap everything we have covered, so it is absolutely clear in your mind. Beginning with the 2026 tax year, the IRS is introducing expanded mandatory questions on the regular tax return that will specifically affect seniors over 60 and anyone who was not born a U.S. citizen. These questions will focus on foreign bank accounts, foreign pensions, foreign Social Security benefits, and other financial connections outside the United States. The reporting thresholds for Form 8938 are being lowered, which means many more people will now be required to report foreign assets than ever before. The IRS will also be cross-checking information more aggressively between tax returns, FBR filings, and immigration records, leaving much less room for mistakes or misunderstandings. For green card holders and people applying for citizenship, accurate tax reporting will become even more important because discrepancies can lead to delays or extra scrutiny. None of this means that honest taxpayers should panic. It simply means that paying attention to foreign financial reporting will no longer be optional. By gathering your records early, understanding your obligations, and seeking help when needed, you can navigate this change smoothly and confidently. The people who prepare ahead of time are the ones who will have nothing to worry about. If you found this video helpful and want to stay updated on future changes that affect seniors and immigrants, consider subscribing so you never miss important information like this. Tax laws and immigration rules can change quickly, and staying informed is one of the best ways to protect yourself and your family. And as always, I need to remind you that everything shared in this video is for general formational purposes only. It is not legal or tax advice. Every person's situation is different, and the rules can be complex depending on your country of origin, your income, and your financial history. If you have questions about your specific case, it is always a good idea to speak with a qualified tax professional or immigration attorney who can review your individual circumstances. Government policies can change, and official guidance from the IRS and USCIS should always be checked when making important decisions. Thank you for spending this time with me and for taking steps to protect your financial and immigration future. I'm Sophia, and I'm here to help you stay informed and prepared. Stay safe, stay organized, and I'll see you in the next.